Hello again. We're going to continue our discussion of revenue recognition. We talked about RevRec and the performance obligations. I'm going to take a deeper dive into those performance obligations when it comes to a multi-year contract over time. There's a method known as the cost to cost method, and it's based on total expenses and what portion of total expenses that we are using to generate the revenue. And we take a percentage of that revenue based on the expense percentage. So if we look at that, we got this cost to cost method. Recognized revenue is a proportion of total costs incurred to full contract price, which is what we just said. For example, 15% of total expected costs to create the product are incurred in the current period, then we're going to recognize 15% of the revenue. And Raytheon, in their footnotes, which again are key and important, and we'll have some discussion exercises and final project that involve the discussion notes, because we want to understand the details here. It's great to have the financial statements in front of you, but those discussions are crucial to really understanding the financial statements. And then Raytheon's comment was revenue is recognized based on the extent of progress towards completion. So percentage of completion method is what we used to call, using a cost-to-cost measure of progress. It's a ratio of costs incurred to date to the total estimated cost of completion, and we multiply that by the revenue of that or the performance obligation covered. So if we look at this, bottom line is we have $7.5 million in costs over the next 2 years. And this is projected, and estimates can change. So it's a $10 million contract, and we're looking at $7.5 million in revenue and expenses to go against the $10 million in revenue. 2 years, costs incurred, year one, $4.5 million. So we take our 4.5 out of the cost of 7.5, which is 60%. Then when the next year, the rest of the cost of 3 million out of 7.5 is 40%. So how much revenue we recognize? Well, based on a $10 million contract, multiply by 60% and 40%, and we get our 6 million of revenue recognized in the first year and 4 million in the second. And this just goes into a little more detail of that you've seen before and how it gets spread out on the income statement. You see the minus 4.5 and the plus 6, the minus 3 and a plus 4. So in the first year, gross profit associated with this transaction, bottom line 1.5 million, 6 minus 4.5. Second year, 4 minus 3 million. We recognize $1 million. Again, we're matching our expenses, our cost of goods, to the revenues. And then this is the big picture, what the gross profit looks like. We just mentioned that. And note that cash collected from the customer may or may not coincide with RevRec. So we might say, well, you can pay us in 3 years and 4 years and 5 years. But when do we recognize it? Accrual basis says when the ownership changes hands per our agreements. We also have on here, if we look at the summary of the balance sheet under current assets, cash and cash equivalents, short-term investments, term of net receivables. We're going to go deeper dive onto why do we have net receivables? I thought accounts receivable is accounts receivable, which it is, and people still owe us the money, but if they go bankrupt, we're probably not going to collect any or most of what is owed. We still might collect some. There's a lot of things called a reorganization under bankruptcy. But we have contract assets. Here's where we're recording the contract assets of the cost incurred, not yet billed. Our inventories, our prepaid expenses, other current assets. And just as a commentary, when PwC, PricewaterhouseCoopers survey, they said, over 60% of the folks say, you know what, not going to be difficult, not a big deal. What's the impact? But it's hard to do. And then they said, yep, it's going to be a major impact, 65 to 80, but we're looking at 15%. And then unsure was a whole bunch as well. How difficult will it be to implement the new standard? Somewhat vary. So the heavy things, reviewing customer contracts, well, the largest majority, documenting the conversion process, quantifying the adjustments. So what are the numbers we need to adjust? Because that will affect how they handled revenues before. And basically, this is standardizing the revenue recognition across industries, across companies, so that everybody doesn't have their own way of managing things. So this is of interest, hopefully, to give you an idea that GAAP changes, GAAP evolves. And RevRec was a long time in process. A bunch of reviews, a bunch of feedback, comments were received from the industry, and the board, the Financial Accounting Standards Board, made the decisions. So thank you for listening to our discussion on RevRec and the standards and the cost-to-cost method. This will conclude the revenue side. The next few modules are going to be talking more about the expense side. Look forward to seeing you soon.